expensive, sneaky tool that just keeps aspiring investors paralyzed. It breaks your will before you even get started, really. And this doubt, it gets fed by these 5 common myths, these Phantom 5 investing myths, as the sources call them.
Phantom 5. Okay, let's tackle those. Let's dispel them. Myth 1, the one that probably stops most people right away. Investing is just too complicated.
Yeah, that's a big one. But the truth is, it's only as complicated as as you make it. Think about driving a car, right?
Okay.
You don't need to be an automotive engineer to drive. You just need the basics, how to operate it, rules of the road. Investing's kind of similar. You learn progressively.
Progressively.
Yeah, the source says treat knowledge like a buffet line. You don't eat everything at once. You just pick what you need for the task right in front of you. Learn enough to do one deal, not enough to teach a finance course.
That makes it feel much more manageable.
Correct.
Okay, what about myth 2? That the best investments need some kind of secret knowledge, something most people can't access, like an insider's club.
Right, the secret club lie. Absolutely not true. Your best investments are almost always going to be in things you already understand or things you commit to understanding really deeply.
Like stick to what you know.
Exactly. Look at Warren Buffett. Famous example, right? He sat out the whole tech boom in the late 90s. Why? He admitted he didn't really understand those businesses deeply.
He prioritized understanding over just chasing the hype.
Precisely. If you don't get the asset, you're not investing. You're gambling. Big difference.
Okay, myth 3. This is the one I hear all the time as an excuse. Investing is fundamentally risky. You're probably going to lose your money.
Yeah, the fear factor. But look, investing, by definition, is committing capital for an expected return. Risk. Ironically, risk is what people bring to the table.
How so?
Through ignorance, impatience, ego, making bad decisions. Great investors, they spend their time minimizing risk. They use sound criteria, proven strategies. The goal is always to make your money going in.
Make your money going in. Meaning?
Meaning you buy right. You buy at a good discount or with really good terms. You don't just buy something and hope the market bails you out later if it was a bad deal to begin with.
Okay, but hold on. Finding that discount, buying right.
Yeah.
That means you're competing with pros, right? People who do this all day. How does an average person, just starting out, fresh from the buffet line, how do they find a great deal?
That's where persistence pays off, which ties right into myth number 4. Successful investors time the market perfectly.
Right, they have a crystal ball.
Yeah, no. The truth is, they don't time the market. The timing finds them.
What do you mean?
You have to be in the market, actively engaged, watchful, networked, all the time. That constant engagement, that's your advantage, not predicting the future.
Can you give an example? Like, what does that engagement look like in practice?
Sure. The sources tell this story about an investor, Dykes Bodford. He was just super watchful, really engaged, and he noticed a bank lowered its foreclosure bid on a property by $100,000.
Wow, $100.
Yeah, just the day before the sale. Because he was ready, had the capital, knew his criteria, could act fast, he had jumped on it, made a quick $100,000 profit.
So he didn't predict it, he was just there, ready.
Exactly. He was in the game, ready to act when the market made, an error.
Okay, that flows perfectly into the last one, myth 5. All the good investments are already gone. They're all taken.
Another classic excuse for inaction. Look, opportunities pop up constantly. And crucially, they don't just come from big economic shifts. They come from constant personal forces.
Personal forces, like what?
Like human life stuff. Divorce, debt, somebody relocating for a job. Sadly, death, job changes, things happen to people. Yesterday's deals are gone, sure. But tomorrow's deals, they haven't even been created yet because the personal situations driving them haven't happened yet. There's always opportunity.
Okay, so if self-doubt is the enemy, and hesitating costs you potentially $100,000, how do we build that fortress against it? Let's shift from the mindset now to the actual system. The sources argue pretty strongly that success isn't luck, it's strategy, it's models.
Yeah, it's about taking luck right out of the game. Think about Monopoly.
Monopoly, okay.
The game isn't really about rolling dice, is it? I mean, not if you want to win consistently. It's about strategy, negotiation, understanding the models.
Of knowing which properties are best.
Exactly. The good players know, say, the orange properties give the best ROI because of where people land most often. They know the model, buy 3 houses and get a hotel for maximum return, proven models, used consistently. They just make luck irrelevant.
And the cost of not using a system, of hesitating, that's huge. I want to touch on that story the author told about his own mistake. The $100,000 he lost out on. that beach condo.
Oh, yeah, that's a painful one, but so important. It was listed for $160,000.
Net worth.
Easily $260,000. Could have flipped it immediately. Huge profit just sitting there.
So what happened?
He saw it, knew it was a great deal, but he stopped. He hesitated, said he needed to think about it, sold the next day, gone. And the psychological hit from that indecision was massive for him. The lesson wasn't just missing the money. It was realizing a real investor, someone with a system, doesn't just walk away when a deal hits their numbers.
Right. You have to shift the question in your head. Stop asking that hesitant, doubt-filled question. Should I make an investment?
Yes.
And start asking the analytical one. Is this the deal?
Yeah.
Does it fit my criteria, my terms, my network?
Exactly. And when you start asking that question, real estate specifically offers some pretty unique financial advantages. It can amplify success way better than, say, just stocks for most people. It's uniquely leverageable.
Okay, explain leverage simply, because this feels like where the real money momentum starts.
Right. Leverage just means you control a large asset with a relatively small amount of your own money, the down payment. But here's the magic. You get the benefit of appreciation and the benefit of the mortgage being paid down on the entire value of the property, not just on your little down payment.
Ah, so your return gets magnified.
Massively magnified. The sources had that example. Property value goes up, say, $9,115. Not bad. But if you only put $30,000 down, that $9 Keller gain is actually a 30.5% return on the cash you invested.
Wow, okay. That's huge.
It is. You're using the bank's money, other people's money, to accelerate your own wealth building. That's leverage.
And beyond leverage, real estate has other big strengths, right? It's rentable.
Yep. Tenants pay down your mortgage. They literally build your equity for you over time.
It's improvable.
Yeah, it's tangible. You can physically fix it up, manage it better, add value directly, unlike a stock certificate.
And then the big one, maybe the most powerful, taxes. The 3Ds, they call them.
Ah, the 3Ds. Yes.
Yes.
Deductible, depreciable, and deferrable. These are game changers.
Break them down. Deductible.
Pretty straightforward. Most of your operating costs, insurance, repairs, property taxes, the interest on your mortgage, you can deduct those against the rental income. Lowers your taxable profit.
Okay. Depreciable. That one sounds weird for real estate, which usually goes up.
It does, but it's huge. The IRS lets you subtract a portion of the property's value on paper each year. It's like a ghost expense for wear and tear, even if the property's actually going up in value.
So it lowers your taxable income, but you didn't actually spend that cash.
Exactly. It shields real cash flow from taxes. It's a massive benefit. And the last one, deferrable.
Deferring taxes. That sounds good.
It is. Through things like a 1031 exchange, you can sell an investment property, take all the profit, and roll it into another similar investment property.
Okay.
Without paying capital gains taxes now, you defer them potentially indefinitely as long as you keep reinvesting.
Okay, those are serious advantages. So we know we're hunting for the deal. We know real estate is a great platform. How do we make the hunt systematic? How do we build that monopoly strategy?
You formalize it. You focus on what the sources call the acquisition dynamic triangle. To consistently know value, recognize opportunity, and actually do deals, you need all 3 points of this triangle working.
And those 3 points are?
Criteria, terms, and network.
Okay, lay out what each one means. Criteria.
Criteria is what you buy. It's about predictable value, what location, what type of property, what condition, what return metrics like cap rate. You define this stuff up front. So when a deal pops up that fits, you can move fast, no hesitation.
Makes sense. Terms.
Terms is how you buy it. And honestly, this is where great deals are often made, not just found. You can negotiate way more than just the price. Think down payment, interest rate, closing timelines, seller financing. Getting good terms can be even more valuable than knocking a bit off the price.
Interesting. Okay, and the last one. Network. Who helps you?
Your network is absolutely critical. It's your investment lifeline. Mentors, partners, maybe investors, definitely real estate agents who really get your criteria, good contractors, lawyers, accountants. You just can't build massive wealth alone. Your network finds deals, helps you analyze them, helps you close them faster and better.
Right. It takes a team. Okay, so once you've got the mindset, you're using the models, the triangle.
Yeah.
Then you start moving through this 4-stage journey the sources outline. Stage 1 is think a million.
Yeah, this is basically everything we talked about at the beginning, that internal spiritual journey, you might say.
Yeah.
Developing the mindset, setting those big goals, finding your big why, adopting the models, building the habits. It's all the prep work.
Got it. Stage 2, buy a million.
Now you're in action. This is the acquisition phase. You're out there actually buying investment properties, aiming for a portfolio with a market value of, say, $1 million or more.
Like John Jacob Astor buying up Manhattan.
Sort of. Yeah, he famously said he'd buy every foot of Manhattan if he could do it over. This stage is pure growth, accumulation, using your criteria, terms, and network relentlessly.
Okay, stage 3, own $1 million. Sounds like a shift here.
Big shift. Now the focus moves from just acquiring to maximizing what you own. This is the buy and hold stage. You're focused on accelerating equity buildup, boosting cash flow from the properties you have.
And this requires personal growth, too.
Absolutely. You move up the ladder from just basic understanding to applied knowledge. Then you develop real wisdom from experience. And finally, it becomes power, meaning it's habitual, unconscious competence. You're not scrambling anymore. You're fine-tuning a well-oiled machine for maximum income.
And that leads to the peak, the summit, stage 4, receive $1 million.
This is it. Reaching the point where your assets are generating, say, $1 million a year in unearned income. And the ultimate goal here, what they call the 7th level, is you become so systematic, your business runs so well.
You hire someone else to run it.
Exactly. You hire a CEO, basically. You step out of the day-to-day grind. You go from I do it to we do it with your team, finally to they do it. You're just managing the overall vision. That's true financial freedom.
Wow. Okay, so bringing this all together for you, the listener, core ideas seem clear. You've got to think like an investor. Get that doubt out of your head.
Yep. Act fast when a deal fits your plan.
Use the models, especially leverage.
And remember, it's a long game. It's all about maximizing that long game, which really comes down to compounding. You know that classic story?
Penny doubling.
Yeah, the penny doubling every day for 30 days. Instead of, say, $1 million up front, where do you end up?
It's way more, isn't it? Like
10 million.
over $10.7 million from one penny. That curve, that exponential growth, that shows the momentum. What starts small grows kind of slowly at first.
Like tenants paying down your mortgage, little bits of appreciation.
Exactly. Plus the tax savings. It all builds.
Yeah.
Slowly, then faster and faster, into this unstoppable financial force. And this whole journey leads us with a final, pretty provocative thought from the source material. It suggests that financial wealth, especially real estate, isn't something you ever truly own. You're more like a steward for a time.
A steward.
Yeah. So the ultimate question you got to wrestle with is this. What future opportunity for yourself, for your family, for causes you care about? What are you willing to risk by not going down this path, by not pursuing financial wealth? It seems like a journey worth taking. And maybe the biggest hurdle is just believing it's actually possible for you.